Good Saturday morning to you, and welcome to On the Mark alongside Mark Papa. I'm Gary Byron. Mark is the president of Financial Resources Group. Financial Resources Group is out of Glastonbury, Connecticut. You can find them online at www.frplan.com. F as in Frank, frplan.com. And you can write this phone number down. You can call it. That would be even better. Of course, and Mark will be happy to take your call. If you call during the show, operators are standing by, as they say. 860-657-8380. Let me give that to you again. I'll slow it down. 860-657-8380. And if you missed any of that, I will be sure to repeat that a couple of times before the show's over. Good morning, Mark. Good to see you there, my friend.
Good morning, Gary. How are you?
Oh, hey, I'm not too shabby. How about you, Ben? You strike me as a guy that's just busy all the time.
No, you know what? I have a steady flow of work, but not busy. I would say steady and manageable. And we have plenty of capacity, but certainly there's not a lot of slack in our day. But, at the end of the day, we're here to help people. So I'm on this radio show for that purpose. So I don't want you to think that I'm too busy for anybody. If you have a problem, an issue, concern, things that may be out of whack, or you found out your beneficiaries weren't done correctly, you found out some of your investments aren't exactly performing well, or you're paying too much in fees, or you just have a shadow of a doubt about your current advisor, whether that's your financial advisor, your tax advisor.
And there's a lot of that, but I bet you get a lot of people coming in through your door because they're not happy with their advisor.
Well, what I heard a lot was the people who came in for the Roth Conversion strategy. By the way, I want to put another plug in that we can largely eliminate or reduce the taxes on those Roth conversions if done correctly. And a lot of people shied away because they saw how big the tax bill was going to be. But I have a new strategy that, it's not free, but it would take your tax bill from a 35% down to more like a 10%. And then it would lower your bill by about 25% or more. And you actually earn a little bit of interest on your money. So I think it's kind of cool. So there's a really interesting strategies out there. CPA designed, tax attorneys and CPAs designed it. I'm not going to reveal it online, but people really need to think out of the box here. And I just did some tax returns from the tax strategies we used last year. And they all came out perfectly fine, got accepted, and there's been no problems. So I think if sending more money to the government is the wrong approach, if you have a lazy CPA that just wants you to add more money to the kitty every year, you need to talk to me, because these are appropriate strategies for people. And that's one of the things I came across is a lot of advisors will tell their clients not to do the Roth conversion because they're afraid that it's going to reduce the balance and it hurts their fee revenue. So I got a lot of that, and that was from many different types of firms and from many different types of prospects. My advisor told me not to do this for the decade prior to me turning 73 and a half. Now I'm 72 and I'm stuck. So if you're in that position, you need to give me a call, because I can get that your Roth converted, I'd say for the most part within a couple of years, 2 to 3 years, if you're willing to look at a strategy.
Speaking of fees, how often do you hear from people that they think they're just spending way too much in fees?
Very rarely. Most people don't know until I expose that.
I was going to say, until you tell them.
Once I expose it, then they feel like they're paying too much.
That's right. All the more reason to sit down and talk to Mark. Last few weeks, you've been talking about an offering that's got a $2,500 value that you will do for people, complimentary. How does someone get in on it? Explain what it is and how they can get in on it.
In a brief, because we have a lot to talk about today. Yeah. It's our full checklist review. It's a 21-point checklist. It's about a couple-hour meeting. We gather statements. We look at tax returns. We look at your home insurance. We're looking for gaps in coverage. As you can see, our insurance companies are either raising premiums or cutting benefits. So you have to really be on top of your home insurance. You have to be on top of your power of attorney to make sure it doesn't go stale. So if you ever need it, your bank or brokerage firm will reject it when you need your money most. So, and then we also look at hidden fees, unnecessary trading costs, unnecessary taxes. So we're big on a lot of that.
God bless
Excuse me, it is allergy season.
I've noticed, especially today.
Bless me.
Let's, of course, God bless. We need all the blessings we can get. Trump was in China. He's Beijing. God bless you again.
No problem.
For the summit with Chinese President Xi Jinping. This, if you think about it, this is the first time a U.S. presidential visit to China since Trump's 2017. Remember back in 2017?
9 years ago. This is a historic trip.
So
Gary. I mean,
why? What are the stakes here?
Huge. I mean, I think the outcome that both sides want. I'd say the Chinese would obviously want a more collaborative way of economic collaboration. Look at who they brought on the plane. I mean, Musk, he does a lot of business in China. He was on Air Force One, as well as Ginseng.
Well, you had like 616 business, or was it 26?
Well, there was rumored to be 12 CEOs that were named on the plane, and there were some others that weren't named. But let's face it, you're not bringing that type of group of people to a summit if you're not trying to get a good deal done for both sides. And I really think that hopefully we see some good faith negotiations. I did hear Trump was not there to really talk about the Iranian situation. However, China is very dependent on Iranian oil, so I think he's keeping that chip in his back pocket. But I think they're there to get a deal done. Okay, they're there to get something done.
What are we hoping to achieve from this meeting?
Well, there's a lot. I think the big one, obviously, Gary, the most consequential, being the most consequential bilateral meeting in years, the agenda is extremely broad. However, it's trade, it's technology, it's those chips. Right, we don't want to give them the best possible, most powerful NVIDIA chips, but I think the Chinese are eventually going to develop their own anyway. Rare earth minerals that are key essential minerals for battery powered vehicles, battery storage, in EVs and other types of industrial, military applications. I think the big one is Taiwan. Obviously, we want to make sure that Taiwan stays protected. They are home of Taiwan Semiconductor. There's a lot at stake with that as well. The Iranian war in the Strait of Hormuz, that's a big deal as well. But I think that's going to sort of be on the back burner. Although the Iranians, as I mentioned in the past, ship a lot of oil to China, so that's going to be quite an interesting bargaining chip there. You have artificial intelligence and nuclear security. So virtually every major theme along affecting global markets around the table in Beijing this week. Hopefully, they can get a few things done on that.
All right, what's China going to want then in return?
I think China's going to want. Obviously, I don't think we're ever going to let them sell their cars in the United States. BYD is really starting to dominate not only the Chinese market, but I heard that all over Europe as well, that they are taking a very big, very big percentage of market share. They can get, cars are more technologically advanced. They're much less expensive to manufacture. So I think people are very afraid of the Chinese auto market. Yeah. I mean, if I were the Japanese, I'd be worried too.
All right. So let's look at it from an investor's perspective.
Yeah.
What should they be thinking about regarding this summit?
All right. So from the U.S. perspective, the top economic priorities are obviously securing stable supply of rare earth minerals. China has used that as let's say, throttled the exports in 2025. Then that caused a real disruption to American manufacturers and semiconductor companies, which is obviously, if you take a look at what's happening with the AI build and compute, semiconductors are absolutely, on fire right now. If you look at the performance of semiconductors stocks, they're on fire because the demand is just massive. I mean, we're looking at a $800 billion to possibly $1 trillion build out of these data centers, and they're going to need lots of chips to power the next AI trade. I also think, though, continued cooperation on blocking fentanyl imports. I think that is how many children and people have we lost to fentanyl overdoses and lacing drugs, and it's going through the Mexican cartels. Through the China and then through the Mexican cartels and through our border, not a good place to be. We need to definitely get that under control. There's also the framework for potential border trade and a parallel investment vehicle between the two countries. I haven't heard much detail on that, so let's hope that something comes out of that till we get a little bit more clarity. And on the security front, U.S. wants to stop propping up Iran and see its influence to help broker a resolution in the Middle East conflict. So there's a lot going on in here. Okay. There's a lot going on.
It's a fascinating and wide-ranging situation that's going on. GDP is holding up. Jobless claims near generational lows. You got strong corporate earnings. I've read that chip stocks are at records. The potential path to S&P 8,000 and a landmark summit that we're talking about now in Beijing. Oh, there's a lot happening at once here, Mark.
Yeah, there is, and I think a lot of the, a lot of this ties into the economic data, which we'll talk about the predictions. But China's primary goal is they want predictability and stability. China's building out its domestic markets. It's building and diversifying its economy. It's trying to become dynamic like the United States, but they're two very different systems, obviously. They are a, one party ruled communist, and we are a democracy. Or we're a constitutional republic, actually, who operates under democracy. So it's two different systems. They're more of a command and control economy where they can, decide what to do without, having to go through Congress like we do in battling and all the horse trading that's going on. But they do want to diversify trade. And I think they're very interested in getting those channels opened up again. And obviously the tariffs that Trump has put on them, I think is another area that they're trying to get resolved. They're trying to, they realize that there's no way we're both competing superpowers. China is our most sophisticated, if you want to call them, competitor we've seen in many decades. They're not the Soviet Union. The Soviet Union did not have a diversified economy. They were closed. They had a few trading partners, and they were relying on a couple of commodities, and didn't really take much to, eventually collapse that economy. But the Chinese are a much different animal.
There's been a lot of talk about GDP now estimates and where the economy is heading. Yeah. The Atlanta Fed's GDP now model is really something I think a lot of people may not be totally familiar with. Would you? I know you're familiar with it. Do you think you could break that down for us a little bit?
Yeah, absolutely. So that's the Atlanta Fed, Gary. They have a very interesting model. They tend to be a little bit more accurate than some of the others, in my opinion. Now, if you're a Democrat, you're going to say, oh, it's all fluff. And if you're a Republican, you like it. So, but, here's the big deal. It updates frequently throughout the quarter as new economic data rolls in, and investors and economists are running estimates of GDP growth before the official numbers actually released. So it uses a methodology very similar to what the Bureau of Economic Analysis uses when it computes the official GDP figure. So think of it as a living, breathing scorecard for the economy. And what we're seeing right now, which I was actually surprised by, because I think even we can get our hopes can be dampened by some of the negative headlines in the media. But I was surprised to see 3.7%. But if you look at the tax cuts, and I know we have inflation, which we'll talk about in a minute. If you look at the tax cuts and the size of the refunds I saw this year going to people who had the same income last year, who came close to owing or might have owed, all got nice refunds this year because of that $12,000 bump up, or the $6,000 bump up for seniors over above 65. Mm-hmm. As long as your income was below $150,000 as a joint couple, you didn't get phased out. So they started phasing you out up to $250K. But not to bore you, it's nice to see that people were getting refunds and actually having to send less money to the government.
Yeah,
that's a stimulus to the economy. And now someone will say because of inflation and higher oil prices, higher food, which also rolled through, which we'll talk about Tuesday and Wednesday. That is dampening that potential impact. But I think also with the amount of money they're spending on artificial intelligence infrastructure, the shortage of jobs and shortage of labor, I mean, there's a lot going into it. I think this economy really could take off. I think it's going to shoot out of the cannon in the second half of the year. Yeah,
so you said 3.7%. Is that what we're seeing right now?
That was GDP now. No, prior to that, it was much lower. In first quarter, came out at 2% annualized, but that was before all the tax refunds came through. But it's still fairly solid growth that suggests the economy is holding its footing. But now that number was a bit below some of the analysts expected, keep in mind that the fourth quarter GDP was only 0.5% in 2025. So we're seeing a meaningful acceleration. So that forward-looking inertia is a very big positive, I think, for the overall economy.
So, okay, the economy, it's growing, but there are some nuances. So what are the risks that you're watching, especially on the growth side right now?
Well, we have to keep an eye on inflation. We have to keep an eye on energy prices. I still think this economy can absorb where the current oil prices is. If it gets a lot worse, then I think it can be definitely to, let's say, we'll call it, I hate to say lower middle class, but let's call it the bottom third. They're the ones that struggle the most with this when this happens. Even the middle class are struggling now. But that's always been the buzzword. I think overall the consumer is a lot stronger than what we're talking about, what you're hearing in the news. And although things are not all that affordable, I think we're working our way. We're on a really good path to getting towards that 2% inflation. And now that, we had tariffs, but then we also have the attack on, the war in Iran. I should call it an attack. It's not an attack, in my opinion. I think it's justified. Here we are. We're going to, hopefully come to some resolution with the Strait of Hormuz, get the oil flowing again, get the negotiations opened up, and hopefully come to some agreement with the Iranians. And I think that'll be a huge black cloud or dark cloud over the market that will lift. But you also have AI-related capital expenditures that I mentioned is a huge put option under the market. I think the other fear is if we do have inflation, the Fed may be needing to raise rates a little bit. I think that's not on the cards. I think they'll probably not cut instead. And then the third thing I would say, the main thing I'm worried about is the yield curve, which is if the yield curve steepens, that means long-term treasuries yields go up. And when you see inflation, that's exactly what happened on Tuesday and Wednesday of last week. And then what ends up happening is now your debt becomes more expensive. It costs more expensive to borrow. It's a drag on the economy and a drag on our federal budget. So we have to be very careful, always be very careful what we do.
Yeah, I would say so. Folks, you are listening to On the Mark along with Mark Papa. I'm Gary Byron. Mark is president of Financial Resources Group throughout of Glastonbury. You can find them online at frplan.com and at 860-657-8380. I'll repeat that more towards the end of the show as well. And we'll give you some information on a $2,500 value that he's got for you. Mark, this is actually breaking news this very morning. The Bureau of Labor Statistics just released the April CPI report just not that long ago. Big numbers. Do you have them there? Because I was going to say, you should walk people through what just came out.
Okay, so on Tuesday, by the way, that's a typo on my part. Tuesday, the Bureau of Labor Statistics, they released the April CPI report in about 2 hours before it went on air. But big numbers. So here's the deal. It's a significant report. It's not a pleasant one. What people were hoping for rate cuts. So the April CPI, again, I think mostly because of what's happening in the Strait of Hormuz and Iran, came in hotter than expected. Headline inflation hit 3.8% year over year in April, up from 3.3% in March. And that's the highest annual inflation rate since May 2023. On a monthly basis, prices rose 0.6%, still elevated, but it did ease from the 0.09 month surge we saw in March. So, some of the data here is suggesting that inflation, as a result of what's happening in the Strait of Hormuz and Iran, is starting to find its way back into the economy. Mostly it's energy, Gary. Energy is the primary culprit. I mean, obviously, energy costs jumped almost 18% annually in April, the steepest 12-month gain since September 2022. So, yeah, that's not not all that. That's not. I mean, it's going to work. What the problem is starting to work its way into the economy and working its way into prices and working its way into the supply chain and the cost of goods, and then that's ultimately hitting the consumer.
But what's driving this?
I'd say mostly sentiment, one, and higher oil prices, two. The expected fuel oil is up 54% year over year. Gas is $4.50 a gallon, so that's definitely having an impact on overall prices.
What about the Fed's preferred gauge? The personal consumption expenditures, the price index there.
Yeah.
What's the Fed's preferred gauge?
Well, the interesting part about the PCE, that was last released on April 30th, and it was covering March. Core PCE, which strips out food and energy, came out about 3.2% year over year, up from 3.0 in February, and headline PCE was 3.5 annually. So the next PCE report covering April won't be out till the end of this month, May 28th. But given what we just saw in this morning's CPI, in Tuesday's CPI, and then the PPI on Wednesday, which also was not a great number for us. If you look at the core month-over-month increase was 1% versus an expected 0.03, and PPI month-over-month increased 1.4 versus 0.05. That goes to show that the inflation problem is starting to come back into the economy. Markets don't like inflation. It points to higher interest rates, and the higher the borrowing costs are, the lower the future earnings of corporations are going to be. And academically, it just doesn't work out for current market valuations. However, we do have some very, very strong corporate earnings, which we can talk about as well, to back that. So I think corporate earnings are fine. So I think it is I'm hoping it's temporary. I'm hoping we can come to a solution in Iran and the Strait of Hormuz. I hope that something good comes out of the China talks, and because China, as one of the world's largest manufacturer, we diversified. A lot of people are diversifying away from China, but they're also a lower cost producer of goods and services that we buy. So
sure, but for
20 years we had no inflation at all.
Where does this leave the Fed?
It leaves the Fed. We have a new chairman coming in. He wants to. I think it's going to delay his ability to wind down the balance sheet like he wanted. And it's going to delay his ability to cut the interest rates in order to get that job done. He needed to cut short-term interest rates so he can steepen the curve and burn off the Fed's balance sheet, which I think is a positive, but that also could potentially steepen the yield curve. And the steeper the yield curve gets, the more money it costs us to borrow. And it might cost banks, mortgages, individuals, our government, which, as you know, we're spending $1 trillion in interest. Not a good place to be.
No.
So it doesn't put them in a very good place at all.
The earnings picture has been nothing short of remarkable. Let's talk about what the numbers are actually saying. Because I know that you follow the Evercore ISI. You cover that. You follow that data very closely.
That's like the market's benchmark for earnings per share data for the S&P 500 or for the market in general. The earnings picture has been nothing short of remarkable, Gary. And let's talk about what the numbers actually are saying. And, let's take a look at the Evercore ISI data. You can Google that, by the way, and bookmark that if you're really, really interested. But the earnings story is the most underappreciated positive in the market. In Evercore's ISI, his name is Julian Emanuel, recently raised his S&P earnings per share forecast from $304 to 304, up from 296. So that's a pretty decent jump. I mean, you're talking 500 companies. Previously citing exceptional results from the reporting season, he also noted that strong beats, meaning people who beat the market more than a penny, beat on revenue and beat on bottom line profits, were much stronger than basically positioned for further upside. And the data backs it up completely, with 83 to 84% of S&P 500 companies have reported so far. 84 have beaten earnings per share estimates. That's a big dump. That's a big number. That's a very strong sign.
No, it's extraordinary.
That's well above the 5-year average of 78% and the 10-year average of 76%. So, all signs point to a bull market, and the market has been very, very. It's why the market's been so resilient in the face of war in China, tariffs. Think about it. It's our companies are performing very, very well.
And the growth rate?
Well, the growth rates. What are you talking about? Blended earnings growth rate, or now running at about 27 to 28% year over year for Q1 2026. So nearly double what analysts were projecting 6 weeks ago. And to put that into perspective, at the start of the first quarter of the year, estimates called for a 13% earnings growth. It more than doubled that number. So that is not a bad sign for our economy at all. And I think for corporate America, technology, financials, they're both leading the way. I think financials X those private lending, by the way. And I want to put a plug in here. I just read another article on more write-downs in the private lending sector. I had a statistic, I won't quote it, but if any advisor is telling you to still put your money in private credit, calling you to put your money in that fund, calling you to write a check, At this point in the game, with all the write-downs that we're seeing, we saw another fund by, I believe, Apollo, $3 billion fund that they want to put out to bid to sell because there's potential defaults in there. I don't know who's going to buy it. Who's going to buy it at a pretty steep discount. But the write-downs are coming. And I just don't think it's a place that I don't think it's going to fail or blow up. But I'm very concerned about some certain software companies that they've lent to. You have to stay away from the sector for now. You got to let it take a breather, let the shoes fall, and then maybe get in on the cheap at some point. But if any advisor is pressing you to buy one of these, you need to give me a call.
Sounds like the fundamentals are actually doing the heavy lifting right now.
Yeah, no, I think the fundamentals are very, very strong, Gary, and I can't really complain at this point.
All right, I got just time for one more question for you, and then I got to wrap things up because everyone's talking about the S&P 8,000. Is that realistic? I mean, where does that market even stand right now?
Well, I mean, based on some of these earnings, some of the earnings data and the momentum that the market has with earnings, I think with productivity, with the AI build out, I think with also we saw a nice broadening of the market where it wasn't just technology companies. I think technologies need to lead the way. However, there's many other areas of the economy that are doing very, very well, and different sectors that are doing well. That we should be able to see that happen. As of today, the S&P 500 is trading around 7,400 to 7,430. It posted another record high last week. The NASDAQ is north of 26,000 and the Dow's approaching 50,000. So we already had an extraordinary run. And the question is, 8,000 achievable? Yes, I think it is.
All right. You got a disclaimer really quickly?
Yes, absolutely. So yes, the opinions expressed during this program are those of Mark Papa personally and do not necessarily reflect the views or positions of Financial Resources Group, LLC. All investments involve risk, including the possible of loss of principal. Nothing discussed in this program constitutes an offer to buy or sell any security or investment product. Past performance is not indicative of future results. Financial Resources Group, LLC is a registered investment advisor in the state of Connecticut. Always consult with a qualified financial professional before making any complicated investment decisions.
Which you are one of. If you like more information on Mark Papa and Financial Resources Group out of Glastonbury, check them out online at www.frplan.com and call to schedule and get that $2,500 value checklist. 860-657-8380. Again, 860-657-8380. For Mark Papa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.